Hi, everyone, this is the Encyclopedia Channel. This program interprets an economics book, Small Island Economics, for you. This book uses a fable to describe several important viewpoints of the Austrian School of Economics and analyzes the factors that restrict economic development. At the same time, the economic problems of the United States are also interspersed in the explanation to support the views of the economic school. So, what is the driving force for economic growth? Why is it said that inflation is a disguised form of debt repayment? What should we do when the economy is in recession? After watching this video, you will understand. We know that there are many schools of thought in economics, including radicals, orthodox and conservatives, macroeconomics and microeconomics, state interventionism and economic liberalism, and so on. Among them, the Austrian School of Economics advocates economic liberalism. They advocate laissez-faire in the market and the government should do nothing. The representative is Hayek, who has won the Nobel Prize in economics. In contrast, Keynesianism supports state intervention. Keynesianism believes that the market economy is inherently unstable and the government needs to help it at critical moments. The debate between the Austrian School of Economics and Keynesianism has a long history. In fact, what Hayek and Keynes wanted to win was the same war. The difference was that Hayek believed that every inch of ground could not be abandoned, while Keynes believed that in order to keep the core fortifications, peripheral positions could be abandoned. Therefore, Hayek is a typical hedgehog scholar, always insisting on only one point of view. Keynes, on the other hand, is a typical fox-type scholar. He is more pragmatic, jumping around and constantly adjusting his views according to changes in the situation. The authors of the book Small Island Economics, Peter Schiff and Andrew Schiff, are staunch supporters of the Austrian School of Economics. The two authors are a pair of brothers, both economists. Because of the period from the Great Depression of the 1920s to the financial crisis of 2008, the United States has been pursuing Keynesianism. Therefore, the whole book is to stand on the standpoint of the Austrian School of Economics and criticize the economic policies pursued by the United States. The author clearly stated in the book that he wants to prove that the economic model advocated by Keynes is wrong and even dangerous. After understanding this background and reading this book again, you may understand why some of the viewpoints and suggestions put forward in the book are relatively idealistic, even somewhat biased, and worthy of discussion. For example, the author believes that inflation is caused by the Federal Reserve, because before the appearance of the Federal Reserve, the United States experienced deflation for more than 100 years, and the economy has developed rapidly. Another example, the author believes that quantitative easing is a variant of inflation, is another dose of poison that will lead the U.S. economy into the abyss, and so on. As for who is right and who is wrong between Austrian economics and Keynesianism, which school is better? We cannot simply draw conclusions, but need to analyze objectively. Each school of economics has its applicable conditions and scope, and each has its own advantages and disadvantages. We need to judge according to different situations. The book Small Island Economics condenses and simplifies the economic history of the United States through a fable, and returns it to its most primitive state. A series of stories such as borrowing, investing, etc. reveal to us how the entire U.S. economic system works. It starts from the most basic and simple economic behavior of fishing on a small island, connects with the reality of the American economy, and uses the form of storytelling to explain those seemingly profound economic principles clearly. For example, the small island in the story was later named the Republic of Macedonia, referring to the original United States. Fish is the real currency, which is equivalent to gold. Ubong savings certificate is equivalent to the real money, that is, dollars. Fishing nets, that is, production equipment, that is, capital. Shacks, that is, real estate, etc. In addition, the people or things mentioned in the story can basically find prototypes in real life, but they are not limited to prototypes. For example, the prototype of Ben Bernanke mentioned in the book is former Federal Reserve Chairman Ben Bernanke, but the Bernanke in the story is not just the real Bernanke himself, but generally refers to those who follow Bernanke. Experts like Nanke advocate high inflation. This program tells the fables on the island and connects with the economic phenomena of American society, focusing on three important viewpoints of the Austrian School of Economics. First, the root cause of economic growth is production, not consumption. Second, to improve deteriorating economic conditions require saving, not consumption. Third, when the economy is in a recession, deflation is needed, not inflation. First part. The first important point is that the root cause of economic growth is production rather than consumption. The so-called economy, to put it bluntly, is to maximize the benefits of limited resources to meet human needs as much as possible. In real life, resource scarcity is the norm, and human needs can never be met. The reason for economic growth is to find better ways of producing the things people need. Through production, limited resources can be maximized to meet human needs as much as possible. Let's talk about the story in the book first. In this book, the story of the island happens like this. Once upon a time, on a small tropical island, people lived very hard. They have only one dish on their menu, fish, and only one variety. This place is very isolated, and people have no advanced fishing techniques or tools. All people can do is jump into the water and catch fish with their hands. This leads to very low efficiency. Each person can only catch one fish per day, and this fish can only guarantee the person's food for the day, and they have to continue fishing the next day. Therefore, the entire economic life of the small island is basically fishing. People wake up, fish, eat fish, and sleep every day. There are no deposits, no loans, no investments, and all the fish caught are consumed. However, everyone wants to live a better life. The protagonist of the story, AI Bo, made a fishing net after thinking hard, which can catch more fish in a shorter time. This increases productivity and Abel has a surplus of property. With such a simple action, the island's economy began to undergo tremendous changes. Abe's behavior illustrates a basic economic principle in this book: consume less and take risks. The so-called insufficient consumption, combined with the story on the island, means that in order to weave the net, Abel cannot go fishing on the day of weaving the net, so he has to be hungry. This does not mean that he does not need fish. However, he chose to temporarily delay consumption, that is, to stop eating fish and weave nets first, in order to be able to catch more fish in the future and improve his life. That's adventure. Before weaving the net, Abel didn't know whether he could succeed. He had never seen any fishing nets, and he didn't know whether the fishing nets worked well. But in the end, Abel succeeded. He made the fishing net and caught more fish. Here, the fishing net is the capital. For the concept of capital, many people only understand it as funds, which is too simple to understand. In the field of economics, capital generally refers to the sum of means of production and money. In Western economic theory, capital refers more to a kind of equipment that can be used to produce other needed things. For example, what Abe wants is fish, not fishing nets, but with fishing nets, it can bring him more fish. Therefore, fishing nets are capital and have value. With the fishing net, Abel's productivity has been greatly improved, and the fish he caught has far exceeded the fish he needs to eat, thus generating surplus products. In order for this story to continue, the book assumes that the fish caught will not rot and deteriorate, and that the extra fish caught by Abel with fishing nets can be saved, sold, exchanged, or invested. Surplus products are the basis of economic operation and the lifeblood of a healthy economy. It can be seen that production promotes economic growth, which is a very important basic principle. But in real life, most Keynesians believe that consumption promotes economic growth, so they advocate that giving people more money to spend can increase demand. The result is just the opposite, which doesn't change real demand, it just makes people pay more for what has already been produced. An example is given in the book. For example, the air has always been there, and it was not produced by anyone. As a result, one day someone started selling air, and you spent 1 million to buy it. At this time, GDP increased by 1 million. But does it actually make sense? You don't create value and the economy doesn't really grow, only production makes consumption worthwhile. Therefore, consumption is only an incentive, a measure used to measure production. Without production, there is nothing to consume. It needs to be said objectively here, understanding that production is the first essence of promoting economic growth is to find the root of economic growth. However, it would be biased to only emphasize this point. The importance of consumption cannot be ruled out. After all, consumption of the produced products can help expand reproduction and realize economic value added, and cannot completely separate the relationship between production and consumption. Relation. Through the explanation just now, we understand that production is the root cause of economic growth. Through production, limited resources can be maximized to meet the needs of human beings. No matter how powerful a country becomes in the end and how complicated its economic system is, this basic principle will not change. This is fundamental. This is the first important point of view of the Austrian school of economics. The second part. We now know that production is the root cause of economic growth. Savings arise when we produce excess. Next, let's look at the second important point of view of the Austrian school of economics, which is saving rather than consumption to improve the deteriorating economic situation. In the book, the story about savings goes like this. Driven by Abel, his two friends, Baker and Charlie, also learned the technique of weaving nets, and the three of them built giant fishing devices together. Soon, there will be a lot of fish on the island, and the savings will also increase. At this time, the storage of fish becomes a problem. In the past, people were always used to keeping fish at home, but doing so was inefficient and dangerous, and it was difficult to guard against fish thieves. So, at this time, a person appeared with an interesting name, Max Houyen Heng, the homonym for a good bank, a very good bank. He opened a fish storage house and asked the islanders to store fish in it, which became savings, and then hired people to guard it. Houyen Heng maintains operations by charging a certain storage fee. However, he is not satisfied with this income. He also uses these savings to lend money, and part of the income he obtains is paid interest to depositors and wages to guards, and the other part is his own profit. Thus, professional banking institutions were born. What is the reality of this story? At the beginning of the last century, the United States experienced a process of urbanization. During this process, a large amount of savings was accumulated, which provided sufficient financial support for other industrial production and commercial activities, and also helped prevent unexpected risks. But in recent years, economists have seriously underestimated the importance of saving, and many of them see saving as a liability. In particular, Keynesians believe that consumption is an important reason for promoting economic growth, and saving money will inhibit consumption, hinder the economic cycle, and be detrimental to development. Under the influence of this view, the government formulates various policies to encourage people to spend money and discourage saving money. As a result, Americans have formed the habit of spending ahead of time, and the result is that they always make ends meet. On the small island, if there is no savings, Houyen Heng will be unemployed, and his investment will be in vain. Therefore, Houyen Heng's personal interests are closely related to the status of the bank he runs, and he is the most suitable person to decide deposit and loan interest rates. For example, in terms of loans, he can charge low interest rates to those with strong repayment ability and high interest rates to those with higher risks as compensation for high risks. The lending rate ultimately determines the deposit rate. The deposit interest rate is also related to the deposit period. The longer the depositor saves, the higher the interest rate, and the shorter the deposit period, the lower the interest rate. Overall, saving helps people increase wealth, delay consumption, and finance investment and production, while increased production capacity improves people's living standards. If things go on like this, a virtuous economic cycle will be formed. In addition, savings serve as an important buffer if the economy is hit unexpectedly, preventing economic collapse or quickly rebuilding damaged assets. Therefore, reducing consumption and saving is a measure to prepare for a rainy day. However, the Fed showed up. For nearly 100 years, the U.S. benchmark interest rate was set by the Federal Reserve. They raise or lower the benchmark interest rate, and the banks will raise or lower the loan interest rate accordingly, which will affect whether the whole market goes up or down. It can be said that the interest rate structure of the entire country is based on this benchmark interest rate. However, according to the book, this mechanism has two major flaws. First, the Federal Reserve is always on top. They are not the main body of economic participation, and they have nothing to do with interest rates. They have no savings and have nothing to do with the operation of the loan, and they will not become the party that suffers losses because they cannot collect their accounts. The second is that the Fed makes decisions more from a political rather than an economic perspective. As a result, there has been a prejudice that interest rates should be low. We all know that low interest rates do stimulate borrowing but inhibit savings. Therefore, the United States has changed from a large saving country to a large borrowing country. When the financial crisis hit in 2008, governments and economists tried various methods to get consumers to spend more and save less. But this consumption for consumption's sake doesn't make much sense. In addition, too low interest rates also send the wrong signal to the market. People think that the economy is in good shape and it is a good time to invest, so everyone borrows more. But in fact, consumption is not really delayed, reserves are not abundant, it is just a false prosperity, and, moreover, a huge crisis is likely to follow. Regarding this point, we still need to analyze it objectively. It would be biased to completely shift the responsibility for inflation to the Federal Reserve. The important role played by the Federal Reserve in the economic and social development of the United States is obvious to all, so I won't go into details here. This is the second important point of view of the Austrian School of Economics. Savings create capital, and capital can expand production. Therefore, when the economy is in bad shape, savings should be made instead of consumption. In a free market economy, banks will lend money to healthy businesses and projects to expand production and add value. From the perspective of society as a whole, the gains from these healthy loans make up for the losses from those failed loans. So, saving $1 has a better impact on the economy than spending it. Moreover, whether it is a commercial loan, consumer loan, or emergency loan, it needs to be carried out within the scope of savings, that is to say, the total amount of loans cannot exceed the total amount of savings. The third part. So, when the economy is in recession, what else can we do besides saving? Next, let's look at the third important point of view of the Austrian School of Economics. When the economy is in recession, deflation is needed, not inflation. The author believes that American Keynesians always demonize deflation, but are relatively accepting of inflation. But in fact, deflation is not a scourge, and inflation is not a cure. One of the important purposes of the establishment of the Federal Reserve was to hope that it could decide whether to expand or tighten the money supply according to the economic operation, so as to ensure that the economy can maintain smooth operation no matter whether it is boom or bust. Let's talk about the story of the small island first. In the beginning, there was no government or country on the small island. The residents on the island can always solve problems in a peaceful way. However, as a simple society becomes increasingly complex, people will inevitably need the emergence of certain government agencies, such as courts that help people resolve disputes, and police stations that help people catch fish thieves. Thus, the government emerged. As mentioned before, with the improvement of productivity, the savings on the island increase, and some residents can work in other industries, such as the service industry and tourism, which creates a social division of labor. For the convenience of exchange, the island regards real fish as currency. Islanders support the work of the government by paying real fish, that is, taxes. However, as the government spends more and more, and the taxes collected are not enough to support these expenditures, the government begins to think of ways. They introduced banknotes, named Yubong savings coupons, and stipulated that there is a certain exchange relationship between real fish and Yubong savings coupons. Fish. In the beginning, the Yubong savings coupons issued by the government corresponded one-to-one with the fish stored in the bank account. But soon, Yubong savings coupons far surpassed that of Yuyu, and the inflation of Yubong was born from this. In this regard, the government claims that fish inflation is due to economic prosperity and higher employment rates, which combine to increase people's demand for fish and thus drive up prices. Without the stimulus of fish inflation, demand for fish would drop or disappear, and the island's economy would shrink. Therefore, inflation is an important part of economic development. What is the reality of this story? We all know that inflation means that the amount of money issued far exceeds the amount of money actually needed in circulation, resulting in currency depreciation and price increases. It can be seen that the rise in prices is the result of inflation, not inflation itself, and it is the money supply that is inflated. However, economists always deliberately confuse the cause of inflation, leading to almost all people now believe that rising prices are inflation. If prices do not rise, there is no inflation. This is to use phenomena to cover up the essence of inflation, that is, the essence of money supply increase. We assume that people are rational, affected by the relationship between supply and demand. When the economy is down, people will not consume. In this way, demand falls, prices fall, and the economic situation is balanced, which is deflation. When the price drops to a certain level, people can accept it again and start spending money. This was originally a necessary process to eliminate outdated production capacity and promote healthy economic development. But the government artificially boosts inflation, inhibiting the process from functioning properly. Because in the eyes of economists and politicians, deflation means an overall decline in prices for a period of time, which is like a plague in the economic field. Therefore, once the signs of deflation are found, the government will quickly take measures to raise prices. But is the price drop really that dire? From the end of the 18th century to 1913, for 150 years, prices in the United States have been steadily declining, but this has not hindered the development of the American economy. On the contrary, it was during these 150 years that the United States experienced several stages of the fastest economic growth in history. The reason is that productivity increases, leading to lower prices. We are not unfamiliar with this situation. The Industrial Revolution led to a substantial increase in productivity, and the living standards of many working-class people have improved. They can also afford high-end furniture, plumbing repairs, and car fares like the rich before. Furthermore, it has been shown that falling prices do not necessarily affect the development of specific industries. For example, at the beginning of the 20th century, Henry Ford reduced the price of luxury cars and made them affordable for ordinary consumers by continuously increasing productivity and lowering prices. The salary level was also the highest in the industry at that time. For example, when the first generation of plasma TVs came out in the United States, the price of $10,000 made many people daunted. However, when the price drops to a certain level, everyone rushes to buy it. Increasing sales made up for the loss caused by falling prices, and profits also increased significantly. So why do some people still think that falling prices are terrible and that deflation is a bad thing? The author believes that there are two reasons. On the one hand, it is because modern economics mistakenly believes that consumption promotes economic growth, so deflation means tightening consumption. But as we explained earlier, it is production, not consumption, that promotes economic growth. On the other hand, for the government, the best way to solve the dilemma of making ends meet may be to print money. By causing inflation and devaluing debts, it is equivalent to repaying debts in another way. Compared with raising taxes to increase revenue or cutting government spending, triggering inflation may be the easiest choice for the government to make, and it is also the last choice. This choice seems easy at first, but in the end it may have to pay a painful price, and this price is the devaluation of the national currency. At present, the status of the US dollar as a reserve currency is still relatively stable. Even if there have been fluctuations of one kind or another before, most countries generally accept the US dollar. However, if the US dollar loses its status as a reserve currency one day, it is likely to collapse like other currencies, and the consequences will be disastrous. Therefore, the author reminds the United States that it must face up to these potential risks, be vigilant at all times, and take precautions before they happen. Of course, this problem is not unique to the United States, and it is also worth facing and paying attention to by other countries. This is the third important point of view of the Austrian School of Economics. When the economy is in recession, consumers are unwilling to spend, and prices will drop to a more reasonable level, thereby stimulating demand. So what we need is deflation, not inflation. Now, let us summarize the content of the program. Using the three important viewpoints of the Austrian School of Economics, we can see the current problems in the U.S. economy and the potential risks of some economic stimulus policies, including, first, production is the key to promoting the economy. The root cause of growth is that blindly stimulating consumption cannot solve the fundamental problem. Second, to improve the deteriorating economic situation, money should be saved, not spent. A certain amount of savings is not only conducive to improving personal consumption capacity, increasing loans, and expanding production, but also helps to deal with unexpected risks. But blindly spending money is only creating false prosperity, and there may be a huge crisis hidden behind it. Third, when the economy is in recession, people will reduce demand and prices will drop. This process helps eliminate some unnecessary production capacity. When prices drop to a certain level, people will consume again. Therefore, deflation is not terrible, and inflation is not a panacea. In short, the author is standing on the standpoint of the Austrian school of economics, criticizing Keynesianism, calling for the market to self-regulate and reduce government intervention. This is the end of this episode of the show. What do you think about it differently? Welcome to leave a message to discuss with everyone. Hey, if you like our channel, please subscribe us. Haha, remember to like it.